Well, hi there. So in this video, we're going to do 3 practice problems about the money market, reserve market, and loanable funds market. Let's get started. Okay, so the first part tells us that the central bank is considering monetary policy to close a recessionary gap. So we're in a recession, and they have ample reserves. So we got some key terms that we're going to kind of try to keep in mind as we do this. Identify specific monetary policy action the bank could take to close the output gap. There's only one that they can take in ample reserves, and that would be to lower administered interest rates, right? And so there are 3 other tools that we could have in a limited reserves framework, but we can only do lowering that with ample reserves. That's why that one's the right answer. At right, draw a calculable graph of the reserve market and show the effect of the action on the policy rate. So we're going to draw that kind of wonky shaped reserve market over here, and we're going to bend that curve. So we got a policy rate up here, policy rate, and we have the first part and a bend and then come down and it flattens out. That's our demand curve. And we have our supply curve that's always going to be vertical for money and reserves. And then we're going to cause this to bend down a little bit farther. And that's going to be our D1, go down, and we're going to connect those with a dot and say PR star, and connect these with a dot and say PR1, and that goes down. Q star, the quantity of money, doesn't change. So we've shown the effect on the policy rate, decreased the policy rate. How would that affect these other things? The price of previously issued bonds. Well, if the interest rate goes down, we know that previously issued bonds go up, right? There's always an inverse relationship. And if the interest rate goes down, what's going to happen to prices? Well, if interest rate goes down, therefore consumption and investment goes up, therefore aggregate demand goes up. I think we wrote this in the lecture notes, and therefore price levels will rise. So that would be maybe a side effect of trying to fix this recession, right? Is that you have more aggregate demand and you fix the recession, but you got higher prices. Number 2, the central bank of Beta Land is concerned about high inflation. They have an ample reserve system. What could they do? Well, they would want to do the opposite of what we just did here, right? If we want to reduce inflation, we're going to want to raise administered interest rates. Raise administered rates. So it's literally just the opposite. If you have too much inflation, you're probably in an expansionary gap. Here it says, draw the reserve market and show that. So we're getting actually 2 reserve questions in here. I thought we were getting a money market question, but policy rate. And so we got this and a bend and then down. Whoa, that was not quite flat, but that's okay. Pretty close. Supply. And then we're going to bend it upward, which is a little wonky if you're not used to it like me. And so up, and I probably could have gone a little bit farther up than what I just did there, but that's okay, right? It's like Bob Ross, happy little policy rates, PR to PR1, and so it's going to rise, and the Q star amount doesn't change. So once again, it's really just the opposite of the graph that we just drew up there. I don't know why that was giving me trouble. That part's done. How would the change affect the following? The quantity of national savings. And so this one's pretty tricky in the sense that what's it going to do? Well, when we raise the interest rate, it's going to actually cause there to be a greater quantity of national savings, right? It's going to increase. And that's because literally there's the kind of direct relationship of higher interest rates are going to induce people to save more quantity of their money. Unemployment rates, though, those are going to increase unemployment because when the interest rate goes up, therefore, consumption and investment go down. Therefore, aggregate demand goes down. Therefore, output goes down. And this here is the kicker for unemployment, right? That lesser output is going to cause unemployment to rise. Now, the last question says, assume that Gamma Land economy is currently operating below full employment output and the government increases spending to close the output gap. So this is a fiscal policy that they're using to fix a recession. It finances it via increased borrowing. So that's kicking me in here that we're going to be talking about the loanable funds market. And it says, show the effect of that increase in government borrowing. Now here we're using I sub R, and it's going to be our standard looking supply and demand. Supply and demand here. And we've got, we'll say Q star and IR star. And it says, show the effect of this. Well, if they're increased borrowing, therefore increased demand. It's the demand for loanable funds. And so there's more demand for it. So we would shift that curve to the right, go over Q1. There's going to be more quantity of loanable funds borrowed. and it's going to be at a higher interest rate. So it's the picture that we drew in the lecture notes. And then last but not least, what's the effect on long-run economic growth potential output in Gamma Land? We would say decrease long-run growth. Because, and we don't want to just write the word crowding out, we're just trying to think about it, right? That's my hint to you. Because the interest rate going up, therefore investment goes down, therefore capital goes down, therefore productivity growth goes down, and that is what slows down our economic growth. And so we're kind of creating these little logical chains here of the higher interest rate is crowding out basically the investment spending that would be borrowing that money. So hopefully this helped you with a little bit more practice on the reserve market and the loanable funds market. I'll see you next time.